On this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. Now on Sky News Business, this is Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open right now on 1300 30 34 35, and of course you can also email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we're very lucky to have Mathan Somasundram from Blue Ocean Equities and Lawrence Parker-Brown from Kadari Securities. Well, what a day for the Australian share market. We saw the best performance for the Aussie share market of 2018 so far. Having said that, the market was only up by 0.75%, but green across the board. And this, of course, is our last Tuesday Your Money, Your Call. We'll be coming back with a new show next week, so keep your eyes tuned. But of course, it is a very special show, but a little bit bittersweet. So if you are a regular viewer, please take the time to call in today with your question. But let's talk about the market. I mean, Mathan, looking at this market, nothing seems to be able to bring it down. Not a US shutdown. Bad news is getting ignored. What does that tell you about the type of market that we're in and what we're in store for in 2018?
I think we're in store for a bumpy ride. I think everyone's overly positive. It's always a bad sign. I'd rather be everyone, start of the year very pessimistic. There's upside to the market. I think the problem here is we do see the upside. We all know about the upside. But people are ignoring the downside risk. And the problem with that is it never actually eventuates till something left field comes through, knocks us, and then we see the downside risk. So that's the risk that you're going to be looking at. And the problem is you can't be outside the market because the market's running. So you've got FOMO on one side and I suppose the ignored risk on the other side. So I think it's a tough year for investors.
So you have fear of missing out, you've got lofty valuations, and then you have central banks around the globe looking at raising interest rates. So what do you do, Lawrence?
It's a great conundrum, and I think one thing that's worth considering is we look at the index, which is obviously something good to calibrate the general performance of the market. I think it's probably, I hope I'm in the sort of mainstream here, that it's probably a stock picker's market, and depending on what you particularly like out there, whether it be by sector or whether you want to go on a business specific level, I think that's where you could maybe have an exciting year and outperform the index. I think particularly given the Royal Commission and that weight on the banks and their growth, it's entirely plausible to build a hypothesis where the index doesn't really move come the end of 2018. Okay,
so both of you are pretty cautious around the market despite the very strong start that we're seeing, especially in terms of the US stock market. Are you a little bit more bullish in terms of offshore markets? Once again, another record high in terms of the US stock market. Last year we saw the MSCI Global Index up by a massive 20%. Should Australians be getting exposure offshore, Mathan?
I think diversification always makes sense. I think it just gets to a point where you shouldn't be going overseas to pick stocks or sectors. If you want the diversification, get some big market exposure. But I think when you're better off looking at a smaller range. So for us, we look at the Australian market very thoroughly. So for us, we tend to look at that for more stock picking. But on a global basis, there are some sectors where you just can't get that exposure here. And Lawrence is right that we, in the local market, so heavily weighted for financials and resources. If either of them have a bad year, then the index is not going to do a lot. But in reality, you can be invested in a lot of stocks that have done substantially well over time. And we're seeing that. So you look at all the stocks that are doing really well over the last 12 months, they've done even better in the last 3 months because most of the people have gone back to those winners and they're doubling their bets. So there is more and more, I suppose, valuation expansion on the good stocks, and it makes it even harder for people to try and find value.
I mean, talking about hard and value tech stocks, another record high for the likes of Altium, Appen today, WiseTech just 2 cents away from an all-time record high, which it reached just a few days ago. So the tech sector has been behind a lot of the gains that we've seen in the US, and of course overnight, one of those FANG stocks, Netflix, just shooting the lights out. Is it too late to get on the tech bandwagon if you're not already on there?
Great question, Julia, because I think that is one of the things that you can be too sort of cautious in the market. I think people have been looking at the FANG stocks for 6 months saying, look how much they've run. The beauty of the tech scene in Australia is that we've sort of for quite some time felt that we had a bit of a paucity of options. Obviously, there are some great businesses out there, but they're not necessarily established household names. As you say, the likes of WiseTech, Altium, they're all having a really sort of exciting period. Now, the lofty valuations are make a lot of people cautious, but I think one thing that's exciting is if you can, as Mathan says, look at an Australian business that can export and really go global, then maybe it can justify, particularly if the earnings are encouraging. So I think that the tech scene is something to watch this year, but as you say, Julia, there's every reason to feel that these PEs, we saw with Aconex exactly 12 months ago, that if they have any wobble in this reporting season, at least one of them might have a sort of choppy month of February.
Okay, so is there any tech stocks in particular that you're watching for potentially a disappointing result come this February earnings season, given the valuations, the run-up, and I guess the optimism in this space with the Aconex takeover?
As you say, that idea that there could be acquisitions is quite exciting. The likes of WiseTech obviously have taken on sort of acquisitions themselves. So if there was any sort of challenges there, if Richard White sort of comes out and says, well, one element's not quite growing as we'd hoped, I suppose that could be under pressure. And I remember Altium, I think 12 months ago, started to flag that they were having some legal issues in China with copyright. So, but you're a very clever person, cleverer than me, if you can anticipate exactly which one is going to come out and say, sorry guys, not quite the growth we were hoping for.
Absolutely. I mean, looking at that tech space, are you wary on a few of these? It's half-year reporting season in February.
Yeah, look, it's the Aussie FANGs, right? You're looking at WiseTech, you're looking at Altium, you're looking at Appen, you're looking at Gentrack, and you're looking at Hansen, NextDC, and Aconex used to be there.
All of them?
I think you do. You're basically, if you look at the high PE industrials, over the last 10, 15 years, they're actually trading at historical high multiples, even for their lofty valuations. So most of these stocks are trading somewhere around 2 standard deviation premium to their lofty valuation. So we're out there. I mean, they can't really disappoint too much. And so when you really compare our FANGs to the US FANGs, the US FANGs are actually really cheap on relative basis. They're a dominant market player and they're cheaper than our tech stocks. So that tells you why people continue to buy them. But I think our stocks will do relatively well because in our market, it's really hard to find stocks that are consistently delivering 20+ growth rate.
And that's the key. This market is all about growth, and we know that in bull markets, growth outperforms. So what happens to, some of those bond proxies like Sydney Airports, Transurban, the property sector, utilities, which have been pretty smashed at the beginning of the year? What do you think, Mathan?
Look, I think you have to have a view that what's going to happen with interest rates. That's the big thing, right? I kind of simplify it to the basics. If the Fed, who is the dominant player in the central banks, if they're shrinking their balance sheet, so should you. So it's just, it's a matter of time before it bites. And so, it's very hard to time these things, but follow the leader. And the leader is the US Fed. Everyone else is a sideshow. So in reality, when they're shrinking their balance sheet, I think you should be shrinking your balance sheet. So I think all the yield stocks will struggle. You're seeing the bond yields run. I think we've probably seen the bottom in bond yields at least for the next 6 to 12 months. So most of these share prices in utilities, property trust will struggle. Infrastructure is probably going to hold up better than the utilities, but they will struggle as well. So in context, I think the yield thematic will struggle this year.
Okay, so you heard it here. It's the growth thematic for 2018. We do have our first caller on the line. Welcome, Monica from Sydney. Great to have you on the show. How can we help you out tonight?
Hi, Julia. Just wondering about Mastermyne, MYE.
Sure.
We have it, but it's not actually doing anything at the moment. And AZJ Horizon, was thinking of getting into that one. Just
Sure.
wondering what your thoughts are.
So having a look, I guess, at the contracting space and services to the mining sector, looking at Mastermyne as well as Horizon. Horizon, of course, having the rail and the freight network, especially over in Queensland. But let's start off with Mastermyne. It is a smaller company, about $82 million market cap. It wasn't too long ago where it did a capital raising, so that might be what's holding back its share price. But also recently, I think we've heard some positive news coming through from the business, updating guidance guidance at the same time, and that was an upward guidance. So previously they had been forecasting $160 to $180 million in terms of revenue for FY18. They upgraded that to $180 to $200 million, and also upgrading their earnings expectations as well. The stock's about 82 cents at the moment. What do you think of the mining services area, Nathan?
Oh, look, in the small cap space, that's the sector to be. Has been for about a good part of a year and a half. The overall capex cycle turned probably at the end of 2015, and capex has been growing, and most analysts have been increasing their capex outlook growth. So in that context, it's got to flow through the mining services. The good thing about mining services is they went through the tough period. Most of these stocks went through the near-death experience. If you didn't get blown away, you're doing well now. So most of the contracts they probably had have got no margins. Now they're seeing expansion in margins, so they should be doing quite well. I've been a big fan of Austin Engineering. The problem with these things is they tend to always take longer than what it should. So most of the miners have been basically really shy about spending. So it's going to take a bit of time, but once it starts, you would start to see a lot more contracts coming through. So I think most of those mining services will do well, especially the small ones, because they don't need a lot to really kick in their revenue model. So I'd be a holder. I still like them, and I'm a holder of Austin Engineering, so I like the sector.
Okay, having a look at the sector, there are of course some mining services companies which are exposed to the exploration part, others that are more exposed to, I guess, the intermediate part of the cycle. What do you prefer here? Do you prefer the exploration, a particular exposure to golds or metals or the bulks?
Yeah, I think that's the tough part here. When you start to pick a commodity, things can turn on a dime, literally. So in that context, it's always tough. So you go for the unique players, the guys who are basically going to play, and that's part of the reason why I like Austin, because that plays into the maintenance capex. So that's been put back for a long time. We're talking 4 or 5 years. So all of those things, eventually, those will be the first things that most of the miners will address. Before they go into growth, they're going to handle their maintenance capex. So those services companies that are linked to the maintenance capex will do better in the short term. But I think the exploration, it just comes down to your view on commodity prices over the next couple of years. If you think it's going to remain strong, most of the guys are going to run down their asset. At some point, then they'll have to increase the asset, and the explorations will come and kick. But there is so many good quality mining services who you can go in, who will give you that maintenance capex side. I'd be leaning towards them at the early stage.
Okay, so leaning towards maintenance, but look, the market's not pricing in maintenance, it's pricing in new contract wins. And for new contract wins, generally you need to see extra mining activity, or perhaps even a new mine. With Mastermine, its exposure to Narrabri and the expansion there, that's really driving along their business. But with, some companies like Seven Group Holdings up 120% in the last year, Monadelphous up by 76%, where do you look, and do you like Mastermine and Aurizon?
So Mastermine and Aurizon would be slightly smaller than where our sort of research specialised. But so Monadelphous is one that we've talked to clients a lot about. The points that, in terms of different stories and different plays, the other sort of thematic that I think Nathan was touching on there is that a lot of these sort of established names in mining services, they might benefit from an environment where a lot of these big players like the BHPs and Rios are quite cash rich. You look at Fortescue Metals, and we quite like the idea at $4.60 they potentially have some support, and the question is, okay, they're going to suffer from that lack of the Chinese discount. Can they do something different? Is this transition year with Elizabeth Gaines going to see them maybe get into the lithium story, or something that's quite hot at the moment? So you would imagine that there's going to be some quite interesting movements in the next maybe 18 months. I would imagine that you'll see some sort of exciting acquisitions, and as you say, Julia, looking at different exploratory sort of mines.
Okay, and I guess just having a look at earnings season, this is going to be a key one for mining services because the multiples are running ahead of growth at the moment. Any possibility that we might see some disappointments, or any companies that you're staying away from, Nathan?
Look, I think mining services, the run they've had in the last year or so, you have to say they really can't disappoint. But then it's more to do with outlook statement rather than the numbers for me. So if management is confident that they're seeing a pipeline that's coming through, then I think the multiples will hold. If they're not seeing the pipeline actually being filled up, then there'll be trouble. But I struggle to see most of the mining sectors. And you have to remember, over the last couple of years, most of these guys have diversified their business model, so they're doing a lot more infrastructure work as well. And the reality is the government's, their number one plan is to cut tax, number two is to build something. So in context, that's also should play into their thematic. So I think it should be okay, and especially everyone will talk about the US infrastructure story, even though nothing's been announced, but that's always another sugar hit that's waiting to happen, so that should play into them.
Okay, so liking the space, looking at Mastermind, a little bit smaller than our panelists are used to looking at, but it looks like the growth story for this sector is still pretty much at the beginnings, and while the PE multiples and valuations have gotten ahead of the story of now, it looks like the market really just trading on the potential in the future. Let's get to a viewer email. This one comes from Tim, who asks, can I get the panel's thoughts on the outlook for TPG Telecom? Well, the telecom stocks have been looking a little bit healthier come the beginning of 2018. Still the NBN with a lot of problems here. What's your view on the telecom stocks and TPG in particular?
As you say, look, real sort of sell-off that lasted, around about a year or a little bit longer. And I remember sort of having the caveat that it probably was looking cheap at $4.50 and so forth, but you had to be patient. And the likes of TPG, I think, is probably the most exciting. Vocus still have big auditing challenges, and it looks like even with the split of the divisions, you want to see some stability from Vocus for a couple of reporting seasons. Telstra, the perennial sort of disappointer in terms of innovation that never really seems to kick on, is probably, I'd wait to see Andy Penn say, this is what we're going to do. I think TPG is the way to play the space. There's obviously a few exciting things on the periphery. I know you're well informed with a few of them, and the likes of Speedcast and so forth, but I think if you feel that they're undervalued, and if you have patience, because again, any disappointment could see a reversion to the sort of last 12-month mean. But I think TPG, particularly with that footprint in Singapore, it could be the way to play the space. So I'd be cautious about it right now, probably not buying into the report, but I think it probably could have that run up back to $12 eventually.
$12, that would be a doubling of the price from where we are seeing it now. But I guess people that did get in when the capital raising happened in April 2017 would be doing pretty well. $5.25 was that capital raising. It's sitting at $6.47 now. Once again, is the market getting ahead of itself, or is it focused on the next story? Is it all about 5G and what's up next?
I think the market wants to believe that the telcos are going to turn, mainly because that's been the biggest underperformer, and you're not going to find any large cap stock like TPG or Vocus or Telstra that potentially could double over the next 12 months in any other sector. But I think the problem here is structural, and it's not going to solve itself quickly. As Lauren said, this is going to take time, so you've got to be patient. Unfortunately, the market is not patient. If you look at what the market is looking at and what it's pricing, I think the longest term I can work out is about 3 months. So this is not going to happen very quickly. And if Andy Penn puts on a black skivvy and comes out and says, I'm Apple, I probably think that's the peak cycle. I think Telstra wants to find growth, but it's really hard. So for me, Telstra will struggle on a yield thematic. But TPG is what everyone loves. So if you're going to pick one, that's probably the best one, but you've got to be patient.
And just before we go to a break, talking about TPG, I mean, there's been a bit of speculation, mainly coming from Morningstar, that perhaps we could see a capital raising here. TPG has been pretty conservative with its balance sheet. Would that colour your view at all on the stock, or do you expect to see something like that, given that the shares have run so hard and above most analysts' valuations?
I think it's the valuation of most of these telcos are more linked to what happens with NBN. If NBN gets watered down again, which politically I don't see it happening, but if it doesn't get watered down, I think it's just a tough space. I just don't think you're going to get the big returns in a market where there's a lot more sweet spots. I think over the next 6 months, I don't see a big return out of the telcos.
Okay, so Nathan, a bit cautious. You're a bit more optimistic about the telco space?
Cautiously optimistic. As Nathan said, it's a space where if you have a long-term horizon and you're happy to sit in the stock and maybe have a few disappointing reports along the way, it's possibly value. But I wouldn't be putting the life savings into it, no.
We'll be back with more after this short break. If you'd like to speak with our expert panel, our number 1300 30 34 35. And of course, you can email us yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35. And of course, you can email yourmoney@skynews.com.au. And we now have Ben on the line from Sydney. Ben, welcome to the show. What's your question for our panel tonight?
Yeah, good evening, Julia. Good evening, panel. Julia, I'm a huge fan and so glad I could get on tonight. I've had a couple of questions. The first question
Sure.
is, I'd love to know a little bit about how you use a market depth chart when you're buying and selling stocks, really as an indicator as to whether you think the price is going up or down. I found it rather tricky in recent times, not responding to normal supply and demand laws of economics that I thought applied because it's such a dynamic environment. The second thing, I thought we might put Nathan under a little bit of pressure. You mentioned earlier that naturally as US interest rates go down and the Fed reduces its balance sheet, that we should reduce ours. Does he have a sort of heuristic or rule of thumb about how much he thinks something like Sydney Airports or Transurban will go down for every 25 basis points of interest rate rise that happens in the US? So they're my questions.
Lots of questions coming through from Ben. Firstly, around the market depth screen. So I think this is more around intraday trading, and if you're looking at the market depth screen to get an idea of, I guess, where some key trigger points for the stock might be, where you see a lot of demand or supply coming on in terms of price and how that could impact. And I guess that makes sense logically, Ben, because, you know, lots of buyers drive up the price and lots of sellers drive down the price. So when you're having a look at the market depth screen, you're looking at the buy orders and the sell orders and hopefully where those resistance and support levels might be. However, the reality, I guess, is a little bit different day to day. So I guess, Lawrence, when you're looking at the market depth screen, do you use it at all? Do you find it useful? And of course, given the amount of high frequency trading as well, which sort of distorts it a little bit because you see all these number ones and twos coming up in terms of the number of stocks being traded. How do you use market depth?
Yeah, so market depth, obviously, for Ben, I hope he enjoys sort of, being on the show, and I'm sure a lot of people will be sad to sort of no longer see their VIPs. Ben, I think market depth is something to throw into your calculations. Obviously, the fundamentals of the stock are also relevant, but if you're looking on a depth chart and you see that the buying starts evaporating beyond a certain point, that could be something you'd be cautious about. Likewise, there is a lot of robo trading, and there's a lot of factors that mean that it's not the only thing I'd look at. But we get our dealing team to sort of have a look. Obviously, this time of year is a fascinating time when there's not necessarily the same depth as there will be, hopefully, in a couple of weeks. So it can sometimes distort the market view of a particular stock, given that not all the big names are necessarily putting big orders buy or sell through. So it's something to consider, but I wouldn't of itself use it as the only way to sort of evaluate a stock's performance.
Okay, and I guess the harder question is regarding some of those bond properties like Sydney Airports and Transurban, how you would value it, and of course how much of the valuation comes from what's happening in the US or what has happened in the US with quantitative easing. I do need to mention that I did buy Sydney Airports at $6.75 this week. Should I be selling now? It's hit $6.90. And of course I see it as a trading stock because the market overreacts.
Sure, it always does. You tend to look at every situation. Market always overreacts on the positive side and negative side. So you have to be a bit more, unemotional about these things, and you have to be logical about it. I think what you have to look at is it's very hard to quantify, a change, how much of that it will play out into the share price. But the interesting part for me is you have to always fall back to your default solution. So if you're looking at bond yields, we're in, uncharted territory. Bond yields are not supposed to be this low. Borrowing costs are not supposed to be this low. We're at emergency rates. So in that context, bond rate yields are very, very low. So you should never use that as a proxy for valuing equities. And people do, and that's why we have high multiples. And so it can reverse very quickly. Now, if you're looking at a sector like infrastructure in a rising bond yield environment, when they start to fall off because the market starts to price in higher yield, you have to assume around 5% as your standard bond yield. That's the long-term average. And so when you start to look at that, think of when the share price drops enough that the forecast yield in Sydney Airports or Transurban gets close to 5%, you'll start to see support in the share price. Because the market looks at that as your worst case scenario. So it shouldn't go that far because they are much better asset base than most other utilities, and they have a much higher growth rate than most regulated utilities. But as we said before, market always overreacts, so you'll get that falling. So the price you bought it at is actually a pretty decent price.
Actually, now going back and having a look at the PE ratio of, let's say, the industrial sector where Sydney Airports and Transurban sits, back in 2008 and sort of 2006, which had, I guess, a different sort of bond market to what we have now, the PE ratios were more around 12. They're now around 30.
That's right.
Does that mean you see Sydney Airports halving in price?
Not really, because the reason why Sydney Airports and Transurban are of interest is because they're defensive, sustainable earnings. Their asset base is not going to get suddenly diluted because we still have to be on those roads. We still haven't got a choice between the airports, and Sydney Airports is very good at taking everything I've got when I go through that place. So I think they'll hold on to that. And they've grown their asset base over time. So I think the return on the asset is pretty good with those businesses. They're very well managed. But the problem being is their ability to, I suppose, take advantage of the leverage, that these are massively leveraged businesses. So their leverage will struggle in a rising environment. Interest rates are not going to go back to 8-9%. But even if if RBA takes it to 3-4%, that's going to make it tougher. And I think that's where the downside risk is. But again, every time these stocks are forecasted to give around 5% or more yield, buy them because they're good quality assets. The market will return.
And I guess Nathan comes to the heart of these bond proxies. A lot of these bond proxies, it's all about the amount of debt that they have and the rising cost of borrowing when interest rates go up globally. So having a look at Transurban, Sydney Airports, what's your view short, medium, long term?
Well, one thing to throw into the mix, which I think is a fascinating point, is that people have been calling the end of this sort of a bull market for bonds for quite some time. And whether you're Philip Lowe, Jay Powell, whoever you are, as much as you want to come away from this emergency measure where you've got no leeway, you've got no room to react if anything extraneous happens, if something exogenous to your system occurs, you can't really, I don't think we're ready for negative rates as they are in Japan. So I think they want to drag it up, but they also don't want to inflict a recession on their economies. So I suspect that we're probably overplaying this normalisation in the sense that it'll probably take quite some time. So in the short run, I think if there's ever sort of a panic and you see a Sydney Airport and you think it's reasonably cheap, Sydney Airport, sorry, then as Nathan's alluded to, it's a very well-run asset. Obviously that transition at CEO level will, where's the next level of growth? But I think Sydney Airport is an excellent asset that's worth having a look at. Particularly if there's that volatility. Longer run, yes, it's entirely plausible that we'll start to have that normalisation, particularly over sort of a 3-4 year period, so.
Okay, great conversation about those bond proxies. We'll be back with more after this short break. And remember, if you'd like to speak with us, our number's open. It's on your screen there, 1300 30 34 35. Or, of course, you can email us, yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Australia's Business Channel.
Welcome back to the program. Joining me on the panel tonight, we have Nathan Simasundram from Blue Ocean Equities and also Lawrence Parker-Brown from Kadari Securities. If you have a question you'd like answered, our phone lines are open on 1300 30 34 35, or you can email yourmoney@skynews.com.au. And we now have Shane on the line from Sydney. Shane, welcome to the show. Great to hear from you. How can we help you out tonight?
Good evening to you all. My question is, can the panel suggest some ETFs that would capitalize on the global growth story?
Sure. So looking at ETFs, I guess, to gain exposure to other markets besides Australia, and I mean, would you go with something straight, S&P 500, or would you go smaller, more specialised? Would you even go into China's tech sector? I guess the options are absolutely endless, especially with some of the smart ETFs that we have nowadays as well, which might not necessarily be market weighted either. Lawrence, looking at the ETF world and globally, the world's your oyster. What do you fancy?
Very good afternoon, evening to you, Shane. As Julia's alluded to, there's so much choice, and I'll just briefly, just to sort of capture this, I hope, in an interesting analogy. I once had a very heated discussion with chums at university about like the Domino's pizza menu. Say you've got 30 different ingredients, the permutations of those 30 run into the sort of 30 million or something, so that all the different options you could have. So there's so much choice out there. For Shane, if he likes the story of, say, the NASDAQ, you can and follow that, as Julia's saying, just as a pure, I want to follow the NASDAQ. But likewise, if you want to follow tech globally and you want to get a bit of Tencent, then there are other options. So there's a lot of choice. I guess ultimately it depends on where you think the big leg of growth is going to come. If you look at 2017, you had the UK as a bit of a lagger, you had our domestic market doing sort of 6-7%, and there was so much other growth in the APAC region, in the US. So thematically, you look at the IMF numbers, it's entirely plausible that there'll be global growth in lots of places apart from Australia. So I think there are options for you, Shane. We quite like to get people into the US growth story at the moment, particularly with that tax implication. But it could be a rocky
just
story.
S&P 500
Yeah,
going...
look, I'm in the lifts in Chifley, and there's a NASDAQ ETF that Beta Shares have, which is NDK. If you like the idea of getting into the FANGs, all of them, and you're not sure which will report best, that's an option. So there's a lot of choice.
How about you, May?
Yeah, look, if you look at what's going to happen in the world and you're looking at longer term picture, I think the NASDAQ, you have to be there. I think the global, the US tech giants, they rule the world. They've gone past what the governments can do. They probably have a better balance sheet than most governments. They're probably bigger than most African countries. So in that context, I think they will just consume any new technology that comes through as a competitor. So they will continue to dominate. The Amazons, the Googles, the Netflix, the Facebooks, they will be dominant players for years to come. Yes, there could be something that turns out of the left field, but I think they'll continue to be there for a very long time. So I think the NASDAQ makes sense. I would be very cautious in picking any sector-specific ones, because one thing is about these sectors is when the thematic goes wrong, you'll get caught out. So I actually prefer to play through the fund managers in Australia. There's a number of good quality fund managers who play the global fund, and with them, the great thing is you get the tax benefit of investing in Australia, and you don't carry the currency risk in investing in overseas. At the same time, you get the exposure. So it's a bit of betting each way and having the carrot while eating it too. So in that context, I think those guys give you a very good yield, you get the franking benefits, and you get the global exposure, and you don't have to be the one trying to hedge the currency, and they'll do that for you. So, you got your MFGs, you got your platinums, you've got your perpetuals, they give you those exposure. So I'd be playing through fund managers.
Okay, I'm going to go with something a little bit, I guess, not mainstream. And, the tech stocks have been doing well, and I really do like that theme. I think we're at a juncture in history where we're seeing productivity gains that we haven't seen from the tech sector, contributing to so many different sectors and structurally changing so many sectors. But I think it's the Chinese tech stocks that actually look interesting compared to the US tech stocks. So one of the ETFs that deals in Chinese tech stocks, which there aren't too many around, is KWEB, KWEB. So if you want to get Alibaba, the Tencents of the world, and they are absolutely massive. I think that in the next 10 years, that these names are going to be household names if they aren't already. Let's go to our next caller. We've got Margarita on the line from Sydney. Margarita, how can we help you out tonight?
Hi, good evening to everybody.
Hi.
I love your show. I have a question about Blackmores. You're probably sick about talking about it, but they upgraded their earnings today. And I was thinking of selling some of the shares, and then they've upgraded their earnings, so I thought, maybe I'll just sit on them until they report. So I was in two minds. So I just wanted to hear if anybody had any opinion about that or...
Great question, Margarita. And I can tell you what Nathan's going to say. He's going to say never sell a stock in an upgrade cycle. But, we're looking at vitamins, and it wasn't... I think it was yesterday with those media reports that CITIC is shopping around for a vitamin company, Nature's Way over here in Australia. And usually if you see takeover activity or even a takeover coming through, that boosts valuations of all the stocks in the sectors. But Blackmores, given that, you're the man who said...
Julia knows me too well. Look, I'll put my quant hat on and say, look, on an upgrade, stick to it. You have to remember the whole sector. I suppose you're looking at the sector that's retail exposure to the Chinese market. All of those stocks are doing well. Bellamy's had an upgrade. A2 Milk has had multiple upgrades and is probably going to have more. You've got pretty much Blackmores going in the same way. I mean, Blackmores and Bellamy's had similar kind of experience. They both blew up and they've turned around. costs have come off, new management, they're turning things around, and they are performing well. They're on an upgrade cycle, hold on. Because as we were just discussing, and Julie was saying just then, you want to have exposure to the Chinese market, and they're doing really well. It's one of the fund managers, if you want good Chinese exposure, is Platinum. So for those guys, you just hold on to this.
Sorry, let's rewind. I don't think we've still got Margarita on the line, but I can't see an upgrade for Blackmores that's come through. I guess maybe she was talking about the last one that came through.
Okay.
But nothing came through today. But
I'm more than happy, because all the dynamics that we're seeing in that related sector, all of them have had upgrades. And we've seen changes come through where Blackmores has had. Look, at the end of the day, Blackmores is not a health stock, it's a marketing company. And as a marketing company, they do really, really well. They've been around a long time, they do really well, and the story has turned around. So I'd be backing that story.
I mean, this is an amazing looking chart, Lawrence. The company returned to quarterly growth back in October last year, and having a look at October last year, the shares were, sort of around about $100, $120. They went all the way up to 180, and now we're seeing a pullback to around about 160, but it did get as far down as 155. Buying here or
yeah, sure.
selling?
What an eventful sort of 12 months. I had the pleasure of spending some time with Francesco Destrados on this show, and we were sort of looking at the stock when it was below 100, and it got down to I think 88, 87, something similar. So it's one to really keep an eye on if you hold it, because it's yo-yoing around. It's probably a stock that the market's finding difficult to value. They have that transition period where replacing CEO. Obviously, Chinese policy can turn on a dime in terms of who can and can't export. And as Nathan alludes to, I mean, one of the reasons to be cautious is it doesn't look like there's any evidence ever that vitamin companies have any efficacy in really achieving anything. So long term, I'm cautious, but it was a great buy at below that $100 level. I
what
wouldn't
about
buy.
now?
Yeah, that's where real intelligence kicks in. I'm not really sure. I think I'd probably be cautious right now. Given that the market has sort of pushed this right below 100 already.
I feel like I'm being pulled in two directions. Nathan's saying go for it, and Lawrence is saying not right now. But on to our next question. This one comes from David, who writes, what does the panel make of the major media stocks, including Seven West Media and Nine Entertainment? And correct me if I'm wrong, but these have been on a bit of a bounce. I mean, pretty impressive for Nine Entertainment, especially yesterday. We saw, let's have a look, what did it do? It was up 7% yesterday, up another 1% today. A little bit of a bounce back.
There's a couple of things working for them. One, the data that came out supported that they're seeing a pickup in media revenue in advertising, so especially free to air. So they've got they're seeing some support, because everyone thought, given the potential slowdown in retail that generally flows through into media, that was going to be a tough year, but that's actually hasn't played out yet. So that was a relief rally. The other thing that worked in their favor is when Domain, with the CEO suddenly departing, a lot of people bought that stock as a media stock, even though that's been rebased into the IT sector. So when the money came out of that sector, because people got the shares through Fairfax, so when they sold out, they went to other media stocks to keep the sector thematic. So because of that, all the media stocks got a bit of a bump. So we're seeing that benefit also work through it. So net, they've had a bit of a bounce, but look, I'm still cautious on retail, and media is a flow-on effect. So for me, I can't really get excited.
So not liking any of those media stocks?
No, I'd still be, look, if you had to play it, I think in the longer term play, you play the News Corps, you play the real estate, you play the Domino's, I'm sorry, not Domino's, Domain. But outside that, I think it's really tough.
And look, we're talking about Nine and Seven West Media as though, they move the same, but in actual fact, they moved in the opposite direction. Having a look at Nine, a year ago it was below $1, now it's above $1.60. Whereas Seven West Media a year ago was 85 cents, and that's down to 55 cents. So, Seven West Media hasn't done so well. Nine Entertainment has been doing well. Do you take a contrarian view, or do you back the winner of 2017 and hope it goes again?
Yeah, sure. It is a really tricky space, because getting that advertising revenue in an incredibly competitive environment where you've got Mathan's right. These very powerful US tech stocks, and you make a brilliant point, Julia. The Chinese market has insulated the likes of WeChat, the likes of Alibaba, to the extent where they will have major clout in the APAC region for the next few years. I think it's going to be very difficult, and the challenge will be, where does the growth come from? But likewise, these legacy, the mastheads, some of the magazines, there's always going to be some residual demand for it. So they probably do get oversold from time to time. I'm just nervous about where growth will come for any of these sort of traditional plays. So they're not somewhere I think we sort of do a lot of research on. I'm just sort of cautious as to where the revenue comes from.
Yeah, the other problem is you've got 10. I mean, 10's now with CBS. They are rebuilding and they will get better, and they were pretty bad. So for they're coming off a very low base, they're going to take some market share off both of these guys. So it's not only do you have the tech giants attacking you, you've got a bad boy now turning relatively good with the US balance sheet at the back of it. So they're probably going to get hurt. So I just find it higher competition and a slowing market. It's just a tough place.
So, I mean, Mathan, you prefer the new media companies like, I guess, the Seeks, the Carsales, Domains of the world. What about the more traditional advertising areas like Media or VPN Outdoor?
Big fan. They've got structural growth. Now, the problem with that is you've got the market gets excited about a particular thematic and then it walks away from it. And at this point, people are looking at high growth. They're not the high growth, but they're steady growth. So till the market moves back to it, this is probably going to be a good idea, but you probably won't make money in the short term.
Okay, and what do you think, Lawrence?
Yeah, the idea that you can have sort of rotating boards and maybe some interaction, maybe you can start using QR codes, which aren't so big here. I think Mathan's right, it's something that's logically likely to grow over the next couple of years, but it's probably not getting a lot of discussion and airtime even on Sky Business. So it's probably not where a lot of fund managers are looking to sort of park big parcels. So a reasonably strong thematic that's probably getting ignored in the market, and if the trend isn't there, then I don't see where the marginal buying will come from. But an excellent point. It's probably something that's overlooked right now.
Okay, on that note, we're taking a short break, but we'll be back to answer more of your questions in just a moment. And don't forget, if you'd like to speak with us, our phone lines are open on 1300 30 34 35, or you can email us, yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Sky News Business.
Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35 and your emails, yourmoney@skynews.com.au. And we now have Jeff on the line from Sydney. Jeff, welcome to the show. How can we help you out tonight?
Good evening. Enjoying the show. My question is Wesfarmers.
Sure.
Is it worthwhile buying at this point of time or waiting a while?
Sure. I mean, the last 6 months has been fantastic for Wesfarmers. It's moved from $40 to $44. And in fact, I think a lot of the consumer staple stocks, especially in the shopping centre space, have done well. I guess the standout has been Metcash, though, moving from $2.10 to $3. And just having a look at Woolies, that's sort of gone sideways, but at the upper end of the range here. But certainly Wesfarmers and Metcash have done extremely well over the last 6 months. I guess the question is, looking at this supermarket space, what are you expecting to see? I mean, Lawrence, over in the UK, what we saw during the Christmas period is that while discretionary retailers did it pretty tough, we saw some of these staple retailers or shopping centre supermarkets doing extremely well. Do you think that the numbers are going to show the same experience here in Australia?
Sure. So the challenge will be obviously that Wesfarmers, and I think someone to credit where credit's due, Ben LeBrun's been saying for about 12 months that Wesfarmers trades in that range where it gets as low as about 40 and then can get as high as around 45. Those are approximate figures. They obviously they're not the exact level of support and resistance, but broadly speaking, below where it is now, I think is a good buy. Where it is now, sort of like high 43s, I think there's potential that it'll be a good report, and I think there's the potential that you'll say that it's a space where there's going to be some encouraging numbers, but can it kick above sort of $45? So I think you'd need to, if you wanted to pick it up, you'd have to sort of have the investment hypothesis that you're going to be nice and patient. There's increasing demand. Metcash is doing very, very well, and the likes of Aldi are sort of breaking up that cosy duopoly that used to exist 5-10 years ago. So look, I like Wesfarmers, and I think it gets you a good sort of defensive option in a lot of people's investing, but I wouldn't buy at this level.
Okay, so a no from Lawrence. I noticed that Deutsche Bank has a sell on the stock as well. You know, and we did get an update over in November in its AGM. Is it all about supermarkets for Wesfarmers, or, you know, do you concentrate on what's happening in the UK? And of course, those losses have been a little bit bigger than what the market had been expecting.
Yeah, and the currencies have worked against that as well. And UK is, the economy is doing, I mean, I suppose they're looking at putting up rates, so they're actually doing quite well in that context. We're here, we're not. We're at emergency rates. You know, we're lower than the GFC. Yet we're not going to be putting up rates. So things are weaker than what it looks. So in context, I think it'll be tough. I think consumer spending will struggle, and supermarkets will you know, play a part in that, and I think they'll struggle. There is supermarket wars between Coles and Woolies. They're always trying to get market share off each other. That just means lower prices. That just means lower profits. So that's always going to play out. I think the big kicker, and Lawrence is right, they basically trade, if you looked at it post-GFC, they pretty much trade in that range. They look pricey because they don't have much of a growth outlook. When they get to those mid-40s, and then they fall back to, when you see a 3 in front of it, that's probably a buying opportunity. The big breakout opportunity would be if they trade one of their assets, if they sell Coles and they move off to do maybe insurance, maybe chemicals or something like that. And historically, and we're talking long term, they have been very good asset traders and very good managers of diversified business models. So in that context, it wouldn't shock me, but till that happens, I don't see the growth outlook changing too much. So it's not something that I get excited over. It's cheaper than Woolies, but Metcash is probably the better one out of the lot. But Metcash is looking good because of the hardware, not because of their supermarkets. And Aldi is literally this hunter chasing Metcash around in different states. So at some point, Metcash will stop and Aldi will jump on them. So I just don't get excited by that sector in the next year.
Absolutely. So the double-digit increase that we saw in the first half, pretty much all hardware, mostly hardware driven, but Lawrence not liking Wesfarmers, and a no from Nathan as well. Range trading, selling at around about 45 and buying it just under that $40 mark. Let's go to another viewer email. This one's from James, and James writes, where do you see the big four banks heading in 2018, and which one is your favourite? We'll start off with Lawrence. What do you think?
Well, yeah, I think whenever people sort of spend time with their family around that holiday season and sort of make plans for 2018, I could just imagine the sort of senior managers of all the big four sitting around and thinking, I bet they just want to get through 2018 as pain-free as possible. Let's just navigate this Royal Commission. It's hard to envisage that they're sitting in board meetings saying, acquisitions, we're going to get into tech, we're going to do exciting things. I think they're in a period of consolidation and they just want to ride the year out. So if you're looking to pick up any of the big four, have that in mind. It's not necessarily going to shoot the lights out. Our preferred pick of all four is ANZ. Partly, I think Shane Elliott seems like a pretty impressive chap, and obviously they, along with a lot of the banks, have sort of said no to Asian growth, let's consolidate.
Okay, Nathan, what do you like?
Look, I can't get excited by the banks. They're going to have a tough year. You've got to remember the last couple of years, pretty much all the CEOs have left. People don't leave that kind of pay packet because they're having a good time. They think it's going to be tough. They've had the easy run post-GFC and they're all gone, and the CBA is the last guy leaving. So the sector is going to struggle. They're going to be in the media. Politicians are going to kick them everywhere. So, you know, it's a free punch. So, you know, you're going to have this playing out in the media. So I wouldn't get excited. If I had to pick one, I'd be looking at, I've always been a fan of the bad boys, ANZ and NAB. Remember, the big upside for the banks is they're going to cut a lot of cost out, they're going to fire a lot of people, and they're going to divest a lot of assets. So their balance sheet should look good, the yield should hold, but it'll just sound bad in the media.
Okay, so no one likes the banks at the moment. Maybe go with the fattest because that's where the most cost cutting can happen. I have to agree with both our panellists. The big four banks don't look good, but what might be an option is CYB. You know, the UK raised interest rates for the first time in November. The chart looks interesting there for CYB as well. So if you want to look outside of the big four and Australian-focused banks, there are other options on the market as well. That brings us to the end of the hour, but we'll be back after the break with another hour of Your Money, Your Call. Lawrence and Nathan will be staying on to answer your questions, so make sure you give us a call. Our telephone lines are open on 1300 30 34 35. Stay with us.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. Now, on Sky News Business. This is Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Belldirect. If you have a question about shares, our phone lines are open right now on 1300 30 34 35. And of course, you can also email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we're very lucky to have Mathan Simasundram from Blue Ocean Equities and also Lawrence Parker-Brown from Kadari Securities. Of course, just having a look at the market, and the market has been on a tear. Today, we saw the Australian share market hitting the best gains that we've seen for 2018 so far. Of course, we're only around about halfway, well, just over halfway through the first month of the year, but the market rising 0.75%. Let's go now to a view and email. We've got here Patrick writing in and asking, can you please comment on Mantra? I bought this stock in my SMSF and would like to know if part of the takeover includes a franking payment. Oh, good question, but I would guess not, given it's a foreign company that doesn't have franking credits buying Mantra, although they could distribute their franking credits.
Yeah, they probably could. I have to say I haven't looked at it in that perspective. But you know, if you held it, I can't imagine there's going to be a competing bid. The worry would be if they disappear. So I'd be taking the money and getting out as soon as I can. And if you're looking for a similar kind of exposure, actually the tourism sector has underperformed. You know, even though the thematic has been beautiful and the tourism numbers are ever growing, but the stocks have not responded to that. Probably the best performer is Sealink. That's been almost like a utility, has done really well. So if you had to pick one in that sector, that's probably the one I would lean towards.
Okay, I just had a look at the structure of the takeover, and it's $3.96, but there's the discretion to pay shareholders a special dividend of up to a maximum of 23.5 cents, which would be deducted from the $3.96 value, and the size of any potential special dividend, if declared, will be determined by the Mantra board, including in regard to a range of factors, including the availability of franking credits. So that's around the scheme of arrangement with the core
basically
hotels.
To reduce the price you get and give you as the franking credit. So I'm assuming the directors hold a fair amount of shares, so it's in their interest to give away the franking. It just disappears otherwise anyway.
Yeah,
so
absolutely.
as well.
Absolutely. So when we're talking about franking credits, we're just talking about the tax credits from the tax that the company has already paid here in Australia. Shareholders get a rebate, but of course foreigners can't really use it, so they might as well distribute.
Exactly, for this last sort of leg of the sort of Mantra ownership being domestic. So.
And talking about franking credits, I mean, some of these companies listed on the ASX have massive franking balances, include the likes of BHP Billiton comes to mind. Is that something you're watching this reporting season, the possibility that perhaps we could see something done with these franking balances?
I think also, I mean, you've got to look at the sector in line with what's happening in the macro in that sector as well. So if you look at, as you said, BHP and Rio and so forth, they're probably coming into the positive side of things where their balance sheets are looking so much better, their cash flow is flowing with free cash flow build up. So you would think that they're going to see a payout coming through, and that should take advantage of that franking credit. But it is not something that we concentrate on, but in context, you start looking at, and historically this has been one of the key thematics. Whenever you look at the banks' grossed up, the banks, you generally see the banks seeing support when gross dividend hits about 8-9%. Generally the yield players will come in. So it does have a huge play because of this substantial self-managed super fund base out there. So I think that is something to keep an eye on, but when you're investing, that's not part of our mantra.
Okay, let's go to our next caller. We have Daniel on the line from Sydney. Daniel, welcome to the show. How can we help you out tonight?
Yes, good evening. I'd like to just pick up from a conversation, a few questions I raised a couple of weeks ago. I believe Lawrence was on that particular panel. We were talking about crypto investing and cryptocurrency investing as a vis-a-vis comparing it to the tech.com bubble of the late 90s, and looking at where the market's heading in respect to looking at it as an alternative to nanocap and other, nanocap, microcap, speculative investing. But tonight I don't want to talk about Bitcoin, I don't want to talk about cryptocurrency, but I'd like to talk about the blockchain and the blockchain technology and potential effects or opportunities or disruption it may cause within these ASX stocks. And I know, Julia, you've been pretty open-minded about Bitcoin in the past, open to discussion. Nathan, I'm not sure, and Lawrence, I know, has an open mind about it. So I'd like to throw it over to you. And I know that it's, maybe you could put in context of individual stocks or industries. And I know it's still a bit early, but maybe it's something that we should be tabling, or maybe you can take back to your research people or investment committees to throw into the mix.
Well, no doubt we'll be talking about blockchain more and more into the future. And certainly here in Australia, we're one of the first movers in the space with the ASX taking on blockchain technology or the ledger technology to look at the settlement of our trades over here in Australia. But opening it up. And Lawrence, so we're not talking about Bitcoin now, we're talking about blockchain, which is the technology and the ledger technology underpinning it. But it also seems to be the buzzword of the moment. You're getting everything from, I don't know, I think I heard pizza delivery using blockchain. A few different things out there. What do you think? And what are the sectors most ripe for disruption, the winners and losers?
Sure. And as you say, I think there was that sort of Long Island iced tea company, and one of our sort of Sky Business heroes, Greg McKenna, I think was being mischievous, saying that if you put blockchain in your name, you get a lot more attention. So he had that on his Twitter. Look, the blockchain technology is likely to be adopted, across the board, because having a digital ledger that allows you to sort of instantly account for who's ever had possession of anything is likely to be very powerful, obviously in financial services, but likewise, booking systems for a lot. So logistics companies are likely to want to use blockchain if they don't already. So the blockchain technology has startups, and as you've quite rightly said, Julia, I mean, one thing that's, I think it's sometimes overlooked as a stock is the ASX. You feel that it's I think we're unique. We're the only exchange that has itself listed on itself. That's adopting the technology, and it's likely to probably, be a forerunner. Now, I'd imagine there could be some teething problems along the way, but the technology is likely to be here to stay. And as you say, winners and losers, you'd imagine that there's going to be some acquisitions. I think if you are some of these powerful entities, the likes of the Big Four, will probably look to acquire a few of these blockchain tech so they can have that intellectual property. So I think it's going to be used, across tourism, across anything with ledgers.
Of course, big winners, Kodak overseas, we saw its share price absolutely rocketing on the back of using blockchain.
Kodak coin.
Yeah. The Kodak coin and blockchain technology. But I guess just having a look at blockchain, we haven't really reached a pivotal point here in terms of Australia, or I don't think globally either. But I think there will come a time, probably when the financial institutions get behind adopting this. Where do you see the disruption, the opportunities and the losers?
Yeah, I think Lawrence is right. It's a logistic technology. So in context, it's any kind of a massive transaction. That's where their cost saving is. But interestingly enough, as efficient as it is, it has a limitation in the context that, do you allow someone else to have as much exposure to your customer base, because they're going to hold all the same data that you hold, and it's a copy technology. It's actually not that unique. I used to work in the US, and we used to run a tech company there in Austin, and we had object-oriented programming, which is very similar to, in concept, to blockchain. So the problem with that is, how much are you willing to share? So banks would be a classic target audience, because they do so many transactions. It would fit right into them. But would the banks then allow someone outside the bank to have access to that blockchain technology and share the information? Hell no, because that's what they protect, that's what they make, because they want to know about you more than the other guy. So that's the limitation to it. I think a lot of industries will use blockchain within themselves. They might not want to open it up for other people to look at. So that limits it. For ASX, it's great within. I think the one that I find interesting that hasn't been talked about is Computershare. Because at the end of the day, blockchain should be an obvious choice for someone like Computershare. And in theory, that should reduce their cost base substantially. So similar to banks, does Computershare want to do that? Why? Because they're charging you a lot more. If by doing this, they might have to reduce their cost base, so they probably don't want to do it. So these are the problems in a technology that's new. I think over time it'll happen, but it'll take a lot longer.
And these things, the productivity gains that
Sure.
we're going to see in certain sectors are also linked to, probably the lack of wage growth that we're seeing globally, the technology that's feeding into productivity, the changing of industries. And I would say that every industry would change, probably the way we do business.
Yeah, look, you go to JB Hi-Fi, you ask them for a laptop, they can't actually find where that laptop sits. And if you think of blockchain, for them, that should be part of their logistics. So, those kind of things will improve over time.
So any obvious winners that you see, stocks listed on the market?
I think someone like Computershare would be the biggest winner out of this.
And Lawrence?
We like the ASX, and we feel that that's an opportunity to play something with a growth story. I'm not sure that there's anything that's... who adopts it best? That's a great question mark. I'd imagine that, the big banks are going to be trying to make acquisitions over the next
And it's
couple of
hard
years.
at this stage, so early stage, to try and see how it's going to evolve down the track. But I hope that gives you some ideas. Daniel from Sydney asking about blockchain. We now have Greg on the line once again from Sydney. Greg, welcome to the show. What's your question for our panel tonight?
Hi, Julia. Really enjoy your show.
Hi. Thanks. How can we help you out tonight?
Yes, I'm looking at two stocks. One
Sure.
is an infrastructure stock, APA Group, which I'm looking for some sort of entry point to. It has dropped about $2 off its highs.
Sure.
I think it's trading about $7.90 at the moment. And the other stock I'm interested in is Zenitas, which is in the health sector, ZNT.
Sure. Okay, so two very different stocks. We'll start off with APA. We've been talking about these bond proxies, and I guess one of the big beneficiaries of quantitative easing and the easy monetary policy that we're seeing globally have been these infrastructure stocks, especially a stock like APA. But, gas pipelines is such a beautiful business. But, does that stop you from investing in something like this because of what's happening in terms of the bond markets? Lawrence, what do you think?
So obviously, very good evening, Greg, and everyone's a big fan of Julia's excellent sort of appearances. One thing that you'll have to consider is an entry point for Greg. I think when it's retraced to what looks like close to a level of support on trend, if you love your charts, I think we're probably close to where, if you're really a big believer in technicals, you might want to enter. In terms of it being a monopoly business, that's quite encouraging, but likewise, the amount of debt that they hold will become more and more expensive to service. So all in all, if you've wanted to get into APA, I think we're probably close to a decent entry point.
Okay. How about you, Nathan? What do you think of
Look, the positive side is obviously they're part of a portfolio. You're looking at defensive yield. That plays into it. But this is probably the wrong time to be buying defensive yields. Their growth is by acquiring new pipelines. It's going to get tougher and tougher because they've acquired a fair bit, and ACCC will still have a few issues with them controlling too much. So that's going to play into it. And as you said, as the interest rate cycle goes, the leverage play, this is going to hurt them. So there's probably more downside risk. I just think it's a tough sector at this point. It is one where I know it's probably not the comparison, but if you're looking at a yield stock, I'd probably lean towards someone like AGL. You get a bit of everything. And the other problem is, as much as governments can talk about prices coming down, they're not coming down. Energy prices are going up. And AGL benefits on both sides of the coin, so they should do quite well. AGL trades between around $22, $23 up to about $25 to $27. So if you see it come down to around 22, 23, I think that's a good buy because they do have a much better growth outlook given their retail business and so forth. And so I think that's probably a utility worthwhile looking at in that sector. I think the others will struggle with the growth outlook.
Okay. The other company was a very different one, and that's Zenitas Healthcare. ZNT is the stock code there. It is a smaller company on the market. I think three main areas. They've got primary health, allied health, and in-home care. But very much a model that's been tied to, I guess, acquisitions and growth in that area. And we've seen these type of models before. But of course, with the home health, you've got the baby boomer generation. So this is all about 24-hour care or in-home health. Help. The other parts are things like medical centres, then they have a range of physiotherapy as well as podiatrists, I guess a range of different things that they've been buying up. Ethan, looking at a company like this, what are your thoughts?
I suppose looking at the pieces, if you look at comparisons like Primary and Sonic, they're struggling, and they are seeing I suppose the weak consumer spending coming through on their side. People are cutting back on those type of services as their first point of call. So that part of the business probably will struggle. I think the play on the demographic will still be pretty solid, but there's always regulatory risk in those sectors at this point. If you look at aged care or health, I suppose all of that sector, the government still hasn't articulated a revenue model that the business can settle on. So things can turn around. So I'd be a bit worried on the regulatory side. I still think that sector is really interesting. It's a bit like tourism. It's the obvious trend. We all know that's there. We all know everyone's getting old. We know our demographic is changing. But we also know that sector hasn't made money.
How hard has it been to make money from aged care? Seriously, the last 2 decades.
I think people made it for about 6 months and then lost it over the next 3 years. So it's one of those things where you had this huge run because everyone went, hey, that's obvious. Nothing obvious ever makes money. So it ran up, everyone got excited and then got pummeled. And at this point, even now, the government hasn't actually given any clarity. So that's why I'm a bit skeptical on aged care. I do worry about that.
Nathan has a really good point that the regulatory risk, because a lot of it is Medicare or government funded, and should the funding change, which it probably will given the baby boomer generation is going to be a bigger burden cost-wise on our governments, it's a huge risk. But in terms of the medical centre businesses, we've seen it with other companies in the past, the retention of doctors has been quite difficult.
We heard that from Primary, that they're struggling to get people.
So it's hard to get those GPs in the centres as well.
Absolutely.
But having a look at the share price here, it's up 26%. The share price looks, share chart looks good. What do you think here, Lawrence?
So look, not a business we've done like tremendous research into. As you say, Julia, the client satisfaction, also that's a key concern. I think the staff satisfaction that Primary are sort of alluding to, trying to sort of simplify being a GP and sort of make it a bit more like McDonald's, without being derogatory to either of those institutions, that sort of let's serve people quickly and let's not have sort of such talented, intellectual staff, lots of people can do this job. That doesn't lend itself towards you thinking, I want to have a long-term career in this sort of industry. So keeping quality staff is going to be an issue. And as you say, the regulatory challenge is, first of all, there's going to be rules about how often and the quality and inspection and staffing ratios. And secondly, if you start to make a lot of money and the government's one of your sort of monopsony buyers, they're going to turn around and say, well, hang on a minute, I don't want to keep funding you guys. So all in all, I think, as Nathan said, it's a thematic that's very logical. There are other ways to play it. I think something like a ResMed, a Fisher & Paykel, is potentially a better way, particularly with that export story, if you love the aged care as a sort of strong demographic.
Okay, and I guess we've seen it time and time before, this sort of roll-up model where you're buying that growth, and through acquisitions, you're sort of constrained just by your balance sheet. So I guess the key with these type of things is watch the organic growth and also watch the balance sheet, because if you don't have the capacity to acquire, then usually that's the end of the model. But certainly an interesting company, and the share price growth has been quite good for the last 52 weeks, up around about 26% there. We'll be back with more after this short break. If you'd like to speak with us, our telephone number is 1300 30 34 35, or you can email us, yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35 and your emails, yourmoney@skynews.com.au. And we do have our next caller on the line. So let's go straight to Tulsi from Sydney. Tulsi, welcome to the show. How can we help you tonight?
Thank you, Julia, for taking the call.
My pleasure.
Question regarding Nanosonic and Australian pharmaceutical industries regarding the recent result as well. Thank you.
Sure, so let's start off with Nanosonics. A very interesting stock, a leader in that area of infection control and disinfecting ultrasounds, and of course it's got a new product that's been working on as well. The share price, $2.79, so just getting back to, I guess, testing that $3 level, which is, I guess, is crucial to it technically. Looking at the stock, I know, Lawrence, this has been one that you've liked in the past. Do you still like it?
Yeah, look, I really like the notion of it. I think if all goes to plan, and obviously everyone's got a sort of best case investment outlook, I think this is a sort of business that will be around for some time, and it could be, you know, dare I say it, a sort of a ResMed, even a sort of a mini CSL of Australian sort of success. The challenge they have is that they've obviously got the best kit in the market, in their view, and a new bit coming out. So this disinfectant of endoscopy and all this that can't naturally be sort of sterilised. There's high demand, and they're in hospitals around the world. Now the challenge is you've got to make sure you're a marketing company and you're developing annuity revenue streams by making sure that all these hospitals are renewing on contracts. So it's a different type of challenge from sort of just designing the best technology. It's the challenge of let's make sure we scale this, and we're working with, you know, big buyers like the NHS. So far it seems to be going well, but it's a pretty choppy chart, as you say, Julia, and you know, where's fair value? I think if you buy it, you have some patience and you let it run, because I think everything seems to suggest that this could be a business that we could be very proud of in the next 5 years.
Okay, so liking Nanosonics, I mean, Nathan, the risks are there when you're expanding at the pace you do. I guess one of the biggest markets is the US, where it's had this relationship with GE Health. Unfortunately, GE hasn't been doing so well.
No.
The health,
the only stock in the US that hasn't done well.
The health is still core at the moment, but the risk is there. You know, do you see now as a good time to be buying this stock, or do you think there'll be opportunities down the road? What's your view?
You probably will. Look, I got in this stock very early, a number of years ago, and I got out way too early. I think I got in like about 60, 70 cents, and I got out at 90 cents thinking, about a month later, I'm thinking, I'm a genius. And then a couple of months later, it was $3. But, you know, go figure.
Well, you are a genius, but would you be buying back into the stock?
I think it's an interesting time because the hardest thing in this industry is getting into those hospitals. I mean, in America, it's just, I mean, it's like trying to pull hen's teeth. Because it takes years to market to all the doctors, go through all the, you know, the dancers to get there. So they've got one product in there, and I thought it would take longer than what they did, and I thought it would take, you know, would take them even longer to get the sales growth that they did. So they outperformed on both of those. So now they've got something in there already. With the second product, it's a much easier play because they already know and trust you. So in that context, I would back them to do just as well. And so when you're, you know, these kind of growth stories, the first time they come up with a new product, that's the big run. So, you know, if the second product is any good, this is the time you want to be there. Because when the market starts to look at it and the early sales come through, and I love the market when it goes to extrapolate, that short-term performance just extrapolates to forever, and that's when the real excitement comes in, and I think that's where you'll get the upside. So if you want to play Nanosonic, I think when they're launching a new product, that's when you want to be there.
And I totally agree with you. I love this idea of a new product because that's when the potential of Blue Sky comes into the picture, when you've got something new, a new strategy, new product, new management. But then on the flip side, we know that the healthcare space in the US, it's a regulatory minefield of what could potentially happen. Do you see any risks there?
Look, there's always risk, but they don't play in the exotic area. I mean, it's not fun. Nobody wants to talk about the stuff they do, but they're very good at what they do, and it saves hospitals, one, money, two, it reduces risk. So these are areas, you know, in the health industry, these are, you know, they can actually sit there and say, we save you X amount of money, we reduce your risk exposure. So those things, I think, work in their favor. And there's not, I mean, there are competitors, but what they do, they're very good at. So in that context, I think it's actually relatively well protected, and I can't see regulation coming into the cleaning side. I think it's where they have the big margin plays, you know, the generic drugs at the massive margins, those are the ones first going to be affected. So I think it's relatively defensive.
Okay, so we've been talking about a stock that our panel likes, Nanosonics, but I'm guessing the next stock is one that they won't like, which is API, Australian Pharmaceutical Industries, but we have to go to a break. So stay with us and we'll be back to talk about API after this short break. If you'd like to speak with our expert panel, our number's 1300 30 34 35, or you can email yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Australia's Business Channel.
So I've been to Japan to see how they're powering their industry. Just wondering what we're doing here in Australia.
Hi, good, how are you?
Our power costs has gone from $80,000 a month to $180,000 a month. These are the guys that we had to let go. There's 35 people. I need affordable baseload electricity, 24 hours a day, and I need it 7 days a week.
If countries like Japan are transforming to low emissions and affordable power using Australian coal, surely we can do it too.
Authorised by Greg Evans, Canberra.
As the mercury goes up, so does your power bill. Luckily, you can save up to $750 on your power bill with an energy-efficient pool pump and pay 0% interest. Make the switch today and save. Poolworks, for healthy pool people.
At BHP, we work hard to support our communities because it's their support that helps us deliver the benefits of Australia's natural resources to all Australians. Think big. Think big.
When you want to borrow money, not knowing your credit score before you apply can be a big mistake. Why? Because credit scores are one indicator of your credit risk. If you know you have a high credit score, you may be able to negotiate with a credit provider from an informed position. That's why it pays to get your free credit score. So before applying for a loan, visit getcreditscore.com.au. It takes less than 60 seconds. It's safe and won't affect your credit score. Plus, it's absolutely free. Knowing your credit score before applying for a loan may be able to help you negotiate with a credit provider from an informed position. We connect to Australia's leading credit bureau, so you can be confident in the information we provide. To better understand your borrowing potential, visit getcreditscore.com.au today.
Turn up the heat during the ultimate BMW 2017 plate clearance with hot opportunities and finance offers available across the range.
Accidents happen, and whenever they do, Budget Direct customers get a 24/7 phone and online claims service. But not everyone's a Budget Direct customer.
Hey, buddy. Hop over to the farmhouse. Get Risky some help. You writing this down? Whoa, no, come back. No, wrong way.
Do you get a 24/7 phone and online claims service? Get more with Budget Direct, Money Magazine's Insurer of the Year.
With iiNet's limitless broadband data, there's no end to what you can watch, stream, or download. And it's just $69.99 a month on a no lock-in contract. Release your internet's potential with iiNet, the #1 in customer service.
Back with your money, your call.
Welcome back to the program. Joining me on the panel tonight, we have Mathan Simasundram from Blue Ocean Equities and also Lawrence Parker-Brown from Kadari Securities. And of course, if you have a question you'd like answered, please call us. The number's 1300 30 34 35, or you can email yourmoney@skynews.com.au. And before the break, we promised that we'd be talking about Australian pharmaceutical industries. We've seen a huge day of, I guess, 2-day falls now for the company that owns Priceline, but also pharmacies, and I guess is vertically integrated. So it looks at the wholesale part, the distribution part, as well as the retail part. Is now the time to buy? People like bargains. Is this one a bargain? What do you think, Lawrence?
Yeah, sure, and that's why I think it's going to attract some attention. You look at the PE and you feel that there's going to be residual demand for pharmaceutical products. The challenge is, I mean, you look at, say, Sigma Healthcare trying to sort of branch away from just being a pure play instead of pharmaceuticals and trying to sort of get involved in all sorts of therapies which can command a higher margin. It's a very tough space. The margins aren't really there, and it's a tough retail environment. So personally, general advice, I think it's going to have some more difficult periods ahead, but you know, who knows? I wouldn't buy.
And you know, Washington Soul Patts is a big shareholder in this company. They don't take a lot of missteps. Is this one that, you know, is not going to work out for them? API?
No one's perfect. And API has, I mean, it's not the first downgrade, it's multiple downgrades.
Yeah.
So when it's in a downgrade cycle, again, my quant hat, don't go near it. Because you're playing with fate, and you know, it can get cheaper, and I think it probably will. And you've got to remember there's a fair amount of quant funds sitting in the shareholding, and quant funds, when they get into a downgrade cycle, they'll just keep dumping. So share price probably will go lower. Look, I think it's not a bad business, but the sector is struggling. Pretty much everyone's on a downgrade cycle in that sector. Again, it's a bit like telcos. Even if you hit the bottom, it's probably not going to bounce for at least 6 to 12 months because people want to wait to see the data come through.
And what is behind the downgrades? Is it just, the chemist warehouse and the discount pharmaceutical model, or is it, the big pharma companies going direct rather than going through distribution?
That's part of it, and also I think there's multiple angles to it. One, there is more competition, and number two, the big pharmas are going around things, and that potentially. The other thing in the US that could be very threatening is, places like Amazon helping other people jump through and sell some of the basic stuff, so that might cut into it. And you got to remember, a lot of these guys, they're not making money selling drugs. It's really a retail operation. They're selling a lot of perfumes, they're selling shampoos, they're selling moisturizer. You don't need a lot to sell that. I mean, Amazon can sell that. So there's going to be a challenge. What we heard from them is their basket was shrinking, so the people were spending less in an aggregate level when they go to these things. So, and some of the bigger brands that they were selling now are available on Coles and Woolworths. So that's diluting their specialized shopping experience. So I think it's going to be tough, and I think you want to wait to see at least a half where they're going to see an upgrade. I think it's just going to be too hard to pick.
I guess it almost becomes like, why would you go to a supermarket without food? Almost. But API, unfortunately, in the midst of a downgrade cycle and a lot of competitive pressures, as well as some structural changes happening there. Let's go to our next caller. We have Steve on the line from New South Wales. Steve, welcome. Great to hear from you. How can we help you out tonight?
Hi, thanks for taking the call.
Pleasure.
Just like to get the panel's thoughts on two stocks, please. First one is Novarti Group.
Sure.
Which is a small financial tech company. It seems to be growing quite well. If I could get a technical on that as well, would be great. And the second one is Kathmandu.
Sure.
Yeah, thank you.
Sure. Let's start off with Novarti Group. It is a smaller company. The market capitalization is just under $50 million. Having said that, the market cap has more than doubled in the last 2.5 months. The shares have gone from around about 15 cents to 35 cents trading, 36 cents trading today. The last update though was a pretty strong quarterly update on transaction and revenues coming through. Their unaudited revenues growing from $175,000 in the September quarter to $339,000 in the December quarter. I guess these companies, you look at revenue, there's no profit, you're looking at revenue, you're looking at the growth rate, looking at a company like this, $52 million market cap, around about $300,000 worth of revenue, but strong growth, what do you think?
So, very good evening to Steve. In terms of a technical, so first of all, fundamentals, I'll hold my hands up. I'm no expert looking at it for the first time. If he wants a technical reader, I'll chip in my 2 cents. I think it's coming out of what could be overbought territory. I don't think the MACD looks too exciting. So for Steve, my very tentative general advice, if you want a technical read on that, I think you could probably pause and there might be some further softness to come.
Okay, I guess blockchain is a key word here, and we've been talking about the potential disruption to the banks and financial services. Well, this company is in the midst of it. They're looking at transactions, alternative payments. They've done memorandums of understanding to do with blockchain technology and global transfers. It's so hard to figure out who's going to be the winner, though.
Yeah,
there's so many in this space now.
You pretty much want to follow the hot stock if you're going to play this space, because at the end of the day, the profit is irrelevant. But then, hey, GetSwift is earning $300,000 profit and it's worth $900 million. So God knows how you value these things. But when it becomes hot, people are buying the revenue or the projected revenue multiple, and which is classic .com problem. And I'm old enough to know that never worked. But the reality is, these stocks, when they become hot, people are chasing it and they're willing to pay. So if you're in it and you've seen your share price have a decent bounce over the last 2-3 months, yeah, ride it for what it's worth. But would I be jumping in after the bounce? Probably not, because I think there's much better players out there who've proven their model over time. I think when you're coming at this side of the cycle, it's really hard to, because the fintechs were really a 2017 story, and there's a lot of stocks, and a number of them have now thrown out a blockchain upgrade. So.
Absolutely, and I guess you can always sell your initial investment, and the rest of it's free ride if you are concerned that there's going to be a significant pullback or you're unsure who's going to be the winner and loser in this space. I guess just having a look at what Steve was calling in about. He was calling in about Navadi as well as Kathmandu, KMD. I mean, a lot of these retailers, I know we spoke about Australian pharmaceutical industries, but outside of Priceline have been doing quite well. Lovisa and Noni B's come out with an upgrade. We've heard a few upgrades in the January confession season so far. Kathmandu, very niche. It's been controlling the amount of sales it has. Are you a fan, mate?
Look, the two things that you want to look at, do they have a brand? Can they go overseas? That's the key thing, because locally they're going to struggle unless you have a unique proposition that can withstand competition from someone like Amazon. So for me, locally, Lovisa is a really good model, upgrade cycle, works well, not cheap, but should continue to do well. And my daughter is a very good shopper and she loves it. So I'll give her all the credit, she picked it early. Then you look at someone like Kathmandu, has a really good brand, they've got a growth story that's outside Australia as well. I think it'll do well. I think it's had a really good performance and I think it'll hold up well. There's not too many in that sector that I would pitch. You've got your Breville's and your GUDs that outperformed, and that's because they've got the global growth story. So I think Kathmandu is a good story, but bang for your buck, I think that sector is just too tough. There's better players to be had.
Okay, so not a huge fan of Kathmandu. It's okay, but not the top pick in your space. I mean, I live in Mossman, and we're talking about baby boomer generation. There's a whole bunch of them bushwalking, and I guess if you're into that outdoors, there's only a handful of names out there that sort of cater. Something niche like Kathmandu, would you be backing?
Yeah, I think that it's a niche retailer, and obviously it has its own branded stores, but it has a lot of concession stores. And I could be completely wrong, but I've looked on sort of the UK Amazon. It probably will distribute through Amazon and maybe get into more households that way. So I think it has traction. I'm not the biggest expert on outdoor hiking and so forth, but it seems to be one of the sort of 2 or 3 most popular brands in that space. So that growth story, there's obviously huge demand across Europe and North America. So you could see that being a stock that could grow.
A really good point by Lawrence. Amazon coming in, we see it as so much of a threat, but if you're a vertically integrated retailer and you own your own brand, then it could be a positive in terms of growing your market share.
Yeah, I think inevitably over time most retailers will have to shrink and go to an online model. I think the next generation, and I don't want to sound like I'm too old, but the younger generation do most of their shopping online, and they're willing to buy globally because transport costs are declining so quickly. They can get it within a couple of days. So in context, I think they will shrink, and someone like Kathmandu will adapt to that, and I think they'll probably shrink their stores over time, and they'll probably sell on multiple platforms, whether it's a Chinese platform into Asia or Amazon in US, and that plays into it because they have actually built a very good brand.
Okay, so that was Kathmandu, KMD there. It's time for a viewer email. We've got one here from Rob who writes, can you please give me your thoughts on Collins Food? I love junk food, any food at the moment because I haven't had dinner. So Collins Food is making me salivate at the moment. KFC, looking at KFCs, not only here in Australia but throughout Europe as well.
Germany, Holland.
Lawrence, what do you think of Collins Food?
Yeah, compared to sort of a retail food group that's really struggling, if you want to play that sort of franchised model with some exposure to some, you feel like the German economy looks pretty healthy on all the macro metrics, it's probably the best way to go to play that space. But I'm not the biggest fan of it as a listing on the exchange. I haven't looked at the price action for it recently, but I feel it had a pretty choppy sort of 2017 from memory.
I mean, it's one of those things that smells better than it tastes. Is it the same with the stock? I mean, Lawrence talked about Germany being a strong area, but that was one of the disappointing areas of growth, especially in terms of same store sales as well as the rollout. And look, this is an unusual. Domino's, the updates that we got from some of its international businesses was quite disappointing. And now with Collins Foods, the European part seems to be underperforming.
And that's the problem. You're running multiple brands, but they're very strong brands. If the strong brand goes out of favor, what do? You can't really rebrand the brand. You're stuck with it. Collins Foods, I remember it so well purely because it was one of the big brokers that floated it, and within I think 3 to 6 months they downgraded, and they downgraded massively. And they blamed the Rugby Union World Cup in New Zealand for the KFC short sell. I was like, what? And it got slaughtered within the first year. But it was a huge recovery. Management has done really well. They've grown it. Now, a lot of the growth story is by buying more and more stores. Now, that works in a improving consumer spending outlook and low cost of debt. We've got rising cost of debt, weaker consumer spending, and as you've seen, you've got these doubts on the global business as well. So,
and we're all eating salads. Who eats KFC?
I mean, I always had my doubts when Macca started selling salad that does anyone actually order the salad? But in saying that, I think that you've actually seen declining drinkers of Coke, all that health is being played out, and people are actually changing their attitude. So I think it's going to get tougher and tougher. And if you own KFC, what do? You can't really sell tofu burgers. I mean, it's just not going to work. So in that context, I think it'll be interesting to see how they rebrand themselves.
Okay, we're going to take a short break, but we'll be back to answer more of your questions in just a moment. And if you'd like to speak with that expert panel, our number's 1300 30 34 35, or you can email yourmoney@skynews.com.au.
You're watching Your Money, Your Call on Sky News Business.
Mommy, look what I made.
Have you shown anyone else this, darling?
No, I just made it.
Happy Australia Day, Josie.
Cheers, mate.
Talking about the good old days again, were you?
Australia Day is under serious threat. Save Australia Day. It'll be a sad day if we lose it.
Authorised by Jacinta Price, Alice Springs.
At BHP, we work hard to support our communities because it's their support that helps us deliver the benefits of Australia's natural resources to all Australians. Think big. Think big.
Accidents happen, and whenever they do, Budget Direct customers get a 24/7 phone and online claims service. But not everyone's a Budget Direct customer.
Hey, buddy. Hop over to the farmhouse. Get Risky some help. You writing this down? Whoa, no, come back. No, wrong way.
Do you get a 24/7 phone and online claims service? Get more with Budget Direct, Money Magazine's Insurer of the Year.
You want to get the most out of your business travel budget? Well, Trivago compares over 200 different websites and apps to find you a better hotel without spending too much. And that's how Trivago gets you more for your travel budget. Hotel Trivago.
Turn up the heat during the ultimate BMW 2017 plate clearance with hot opportunities and finance offers available across the range.
As the mercury goes up, so does your power bill. Luckily, you can save up to $750 on your power bill with an energy-efficient pool pump and pay 0% interest. Make the switch today and save. Poolworks, for healthy pool people.
With iiNet's limitless broadband data, there's no end to what you can watch, stream, or download. And it's just $69.99 a month on a no lock-in contract! Release your internet's potential with iiNet, the #1 in customer service.
Now, back with Your Money, Your Call.
Welcome back to Your Money, Your Call. We now have an email here from Karen, and she writes, I'm interested in the healthcare sector. What is your stock pick for a long-term investment? A good question coming through from Karen. I mean, healthcare has been one of those sectors that seems to year in, year out be on the best performers list in terms of sector since the global financial crisis. But You know, it is essentially a defensive sector which has growth characteristics, given that, you know, our sector is dominated by the likes of CSL and Cochlear. So favourite long-term investment? I mean, if you had bought CSL in its IPO, $10,000 worth more than $1.5 million now. What's the next CSL? What do you think, Nathan?
It's very hard to pick the next CSL. There's so much risk in becoming what CSL. It has a unique advantage. If I had to pick a long-term growth story in healthcare, even now, I would go to CSL because it's in an area where it's really hard to compete with it, and it's got the scale, and you know, you give them blood and then they basically play with it and then they give it back to you and then charge you money. Great model. The others, you know, Cochlear, great business. I really love the business, but it's priced for perfection. ResMed, again, it's never cheap. It's a very good business. But the problem with any kind of, I suppose, health technology stock is that some kid somewhere might come up with something that completely annihilates the model. And that's the big risk. But with CSL, they just work on your blood. And you know, they work on, the other thing about CSL is they put so much money into R&D. It's one of the biggest R&D stocks in our market. Now, it doesn't work out probably 99% of the time, but if that 1% ever comes through, the stock could double, triple, because you know, they've got something for flu or this or that. The market is massive. So they are one of the few biotechs that have a very good business and they grow. So if you're looking at the long term, I'd buy CSL even now. You don't worry about, you know, any kind of pullback or something. If you want the exposure, CSL is the one, CSL you buy.
And I guess they are still investing in their portfolio and investing in growth. What do you think, Lauren?
So yeah, look, great business, and the sector, healthcare, obviously, it has that defensive characteristic. It's a pretty Catholic sector. There's a lot of different choice out there. I really quite like ResMed. I was briefly with Helen Daly maybe 2 weeks ago and said I felt ResMed would be sort of one of 3 stocks that I quite like this year. I think that is a tech story where, okay, they've got all that recorded data of all those different patients that they can leverage, but likewise they have the hardware. So I think that's when you can bring something to market like Cochlear that could be quite powerful. So ResMed, Fisher & Paykel's also, I know that, you know, for example, I've forgotten Howard Coleman's company there, terrible memory. They really like Fisher & Paykel because they put so much emphasis on research and development, and they've got that Mexico story. I think ResMed is a stock that hopefully over 5 years could really grow from here.
You've both gone with the big ones, I guess, in the space. What about, I guess...
out there, one of the smaller ones?
The cannabis, the medicinal cannabis, stem cells, cure for cancer, anything a little bit out there?
If you're looking at the biotech space, one I've dabbed at a number of times is Bionomics. Now, the hardest thing about, BNO, the hardest thing about biotech space is because most of them are driven by 1 or 2 specific drugs in a 1 or 2 specific markets, if that doesn't pan out, the valuation goes to nothing. Where Bionomics is quite different in the context that they work on multiple things. So they've got 5 or 6 things going at any given time. They are cashed up, so they're not going to raise a lot of money. I think they've got some 40-50 million in cash. And they basically work drugs to a certain level, and then they partner with them. So they've partnered numerous times with Merck and a few other places. So in that context, they tend to do that. And if one of them ever turned out to be a drug, then the market cap could double, triple. So Bionomics is a good, safe play. I would be buying that somewhere around, you know, the high 30s. And if it, you know, they do a deal every so often, and they get paid something like, you know, anywhere from $10 to $50 million. So that just builds up their cash pot. So if they get anything right, this could be, you know, 2-3 bagger. Okay. Otherwise, it's relatively defensive around that price.
Okay, so in the biotech space, Bionomics, BNO is the stock code there. Anything on the smaller, more speculative end, Lawrence?
Not the world expert, and it's team investor. My team will hit me in the face if I can't remember simple things like that. Nanosonics is probably one where I think it could be a really exciting growth story, which we obviously touched upon. So I think there's a lot of choice out there. You know, I know that we sort of analyse just because one of the client holds it, Noxopharm, and there's some exciting research that's happening, but I'd go for ResMed.
Okay, so plenty of ideas from our panellists there. We do have our last email of the night, and this one's from Lucy, and she writes, can I get the panel's view on Bellamy's Australia and A2 Milk? Funny that they you know, you've written in about Bellamy's and A2 milk. I was just at the supermarket and there were empty shelves when I went to look for baby infant formula because I have a baby. Well, both of my kids still have infant formula, and the A2 milk shelves were cleaned out. I'm thinking, what's with this Synlait deal where they're supposed to double production? And then I had a closer look at the prices, and I hadn't realised that, you know, for A2 milk I'd been paying $35.60 a can versus Bellamy's, which is $28 a can. What a nice situation for A2 milk, where the margins, well, it's so much fatter than Bellamy's. I just couldn't believe the difference. Lawrence, if you had to pick one, I think Bellamy's actually hit an all-time record high today, but both in an upgrade cycle. What do you think here?
I think A2 milk and Bellamy's are fascinating prospects for their growth. Bellamy's has had a really interesting year, so kudos to Cohen and his team that came into a business that was really cash poor and had a big inventory. I think A2's high quality. As you mentioned, Julia, it's in that growth cycle where you feel that it might be choppy for a little period, but it could be a $10 stock before long. So yeah, A2's our pick of the two.
A2 is too expensive.
Look, it's always expensive, but it's an upgrade cycle. It's playing the thematic. Both of them are doing well. I'm happy to hold both. But, you know, I think the big risk is when you got to remember this is Chinese market. The regulatory changes in China could happen in a change overnight. So you got to be aware of that risk.
And, you know, we've seen it in the past where there's been sabotage as well. So you've always, I guess, have to keep the risks in mind. But what a phenomenal run. That's all we have time for today. Thanks so much to Mathan Simasundram from Blue Ocean Equities and Lawrence Parker-Brown, Kadari Securities. And as I mentioned, it's a bittersweet day. It's my last Your Money, Your Call, and it's been a wonderful few years. I did want to thank all the guests who have appeared with me on the program over all those years. And of course to you, our viewers, who did take the time to call and write in. We've loved hearing from you. And of course the show wouldn't have existed without you. But I'm not going anywhere. Starting Monday the 29th of January, I'll be back with a new program, Equity Investor. We'll still be answering your emails and taking your calls, but in a new format that we hope you'll enjoy, including some brand new segments that will offer some fresh insights when it comes to investing in shares. Until then, many happy returns. I'm Julia Lee from Bell Direct. See you next week.